Everybody, welcome back to another valuation investing video. And today in this video, I'm going to be going over Adobe stock, which has had a pretty rough 5 years, and especially over the past year, the stock has not been performing well. And also because of fears over AI taking over the business industry, plus competition in this business has really affected Adobe's stock price. With that being said, I'm going to be looking at Adobe using my 7-step stock analysis, and then at the end of the video, I'm going to be using my intrinsic value calculator. But first, let's get into what the company does. But first, let's talk more about the company. So taking a look here at Adobe stock, we can see Adobe stock over the past year is down 34% almost. And today it's down even more. It's down at about $340. So this stock is really tanking. And if we take a look at how Adobe makes money, they do it through the sale of software subscriptions and licensing. Its main revenue streams are divided into 3 segments: digital media, digital experience, and publishing. So the digital media segment includes the Creative Cloud and Document Cloud, generates the majority of Adobe's revenue by offering subscription-based access to its suite of creative software. The digital experience segment provides enterprise solutions for marketing, analytics, and commerce, contributing to significantly to the company's earnings through subscription and service fees. And then the publishing segment, although smaller, adds revenue through licensing fees. And taking a look at all the products that Adobe has, we can see they have Photoshop, they have Illustrator, they have After Effects, Premiere Pro. They have all these products that they offer through their software: Creative Cloud, Experience Cloud, they have Acrobat. They have so many things for people to buy, which gives people a good reason to buy into the software and keep the subscription, in which 94% right here it says is subscription based revenue. So this company has a lot of recurring revenue, which is a pretty good sign to me. I personally like companies that have subscription based revenue because you can pretty much count on this company continuing to grow over time. And taking a look at some positive factors for Adobe, we can see that artificial intelligence could be a positive for the company because it is an undervalued, high-quality software franchise that is primed for AI to bolster its growth vectors. But the problem is, some people really don't believe that. But if you do believe it, I think this is a good company to buy. They have some good marketing position, and the value of this stock is pretty low. But growth expectations is a negative factor. Investors may have to be patient for the inflection in growth. Also, the market sentiment for Adobe is pretty low because of pricing power and lack of product innovation, and potential to improve growth isn't really there as much. And here's a few more negative factors for Adobe, in which generative AI and competition in this space, where people view AI as potentially hurting this company while others say it could help them. They say that it could potentially hurt them because with products such as Photoshop and Premiere Pro, if you can just ask AI, then there's no really need for those products. So then this could harm Adobe's subscription, and people might be canceling their subscription because they won't really need Photoshop anymore. Also, the pricing power of this company isn't as good. The ease and affordability of new AI tools could put pressure on Adobe because with new things coming out that is cheaper than Adobe, but Adobe is still hanging on with continuing to grow their subscribers and revenue. So that's still good, but in the future it looks like it could be a problem. Also, the slowing growth and weak outlook, which they have disappointing guidance. The company has issued growth projections that have been lower than what analyst investors were expecting. This has led to a reevaluation of Adobe's growth prospects. Also, slowing revenue growth and macroeconomic factors for this company could be some negative factors. If you guys didn't know, there's a company called Figma that just recently IPO'd and had a pretty strong IPO date, but has been going down ever since. But nonetheless, this company is still at a 40 billion plus market cap, and compared to Adobe at a little bit over 100 billion, it's actually pretty close to the same market cap. And the biggest reason I'm talking about this company is, if you didn't know, Adobe tried to acquire Figma because Figma is almost like Adobe, where they were trying to eliminate a major competitor because Figma was a direct and innovative threat to Adobe's dominance. By acquiring it, Adobe would remove a powerful rival, and also they wanted to gain a strong cloud-based platform and access to new user base. but the problem is they were not able to acquire Figma because of a regulatory block where the deal was only terminated because Adobe and Figma concluded there's no clear path to obtaining the necessary regulatory approvals, and there's concerns about a single issue antitrust and competition, which if they did acquire Figma, this could rule that Adobe could become a monopoly and could potentially hurt the company in the future. So that's why they didn't acquire Figma, but Figma as of IPO has been doing really good, so that could be worrying for Adobe. And taking a look at the financial health of Adobe, we can see that the PE ratio is greater than 0, which means the price divided by the earnings, in which that market trades at about a 25 to 30 PE ratio. So this is actually slightly undervalued compared to the market. And also the forward PE ratio is less than 30 at 15. So this is actually a very low forward PE ratio. So with the PE ratio, that's the price divided by the earnings, but the forward PE ratio is the price divided by the future earnings per share, which is what analysts expect the company to report in the next year. So they're actually expecting a pretty good jump in earnings per share because you want to see the forward PE ratio less than the trailing PE ratio. Also, the revenue growth and EPS growth is growing at a pretty nice rate at 14% over the past 5 years. And this is the average growth rate each year. So this is still a very fast growth rate with a company that people are saying is dying. So this is actually surprising to me with this growth rate. But I would like to add, it's a little worrying that the EPS growth is in line with the revenue growth. Normally you want to see the EPS growth greater than the revenue growth, but at least there's still pretty fast growth rates. Also, the shares outstanding decreasing at -3% is a very good sign. And also later in the video, I'll be giving a visual of some of these metrics to give us a good idea of what's actually happening each quarter. So all I have to say is that this is actually a better number than what's here, and I really like that about Adobe. And the total debt to equity ratio is a red X mark, but I would say it's almost about where we want it, where I want it less than 50%. It's at 57%, so it's not too big of a deal. And analysts still expect this company to grow at 12% each year. So with that being said, we got 6 out of the 7 metrics as a check mark, so this is good for Adobe. So with that being said, I'm going to be going over to my intrinsic value calculator, but first, let's go ahead and take a look at the revenue and profit margin, because with my intrinsic value calculator, I have to determine the future revenue growth rate that I think they're going to grow at for the next 5 years, and also the future profit margin. So this is going to give us a good visual and idea of what I think this could be in the future. And as we see here, the revenues keep growing over time at about 14%, but as we can see, the revenue has slowed down a little bit to about 9% each year over the past few years. And also the profit margin, a little bit worrying, is that it is kind of decreasing over time. It's not decreasing by that much, but right now it's at about a 30% profit margin. So it's not terrible, but I would like to see the profit margin increasing over time. But that being said, with my intrinsic value calculator, I'm going to be doing a bear case, base case, and bull case for Adobe. And with the annual revenue growth rate, as we saw, they're growing at about 9% each year, in which I think in the future, this for the bear case, analysts expect them to still grow at Analysts still expected this company to grow at double digits, but I think the bear case for Adobe is, I would say, 6% each year for the next 5 years. I think that's a pretty bearish case for Adobe. And for the base case, I think an 8% growth rate is pretty fair for it because they've been growing at about 9% for the past few years, and I think that's fair. And for the bull case, I'm going to put 10% growth rate over the next 5 years. And this is annual revenue growth rate, just to make sure you guys understand that. And for the future profit margin, right now they're at about a 30% future profit margin. I would say I would worry about this company because of the pricing power this company has is diminishing over time. So for the future profit margin on the bear case, I'm actually going to put a 25 future profit margin. For the base case, I think we can do, let's say, a 29 profit margin. And then for the bull case, I think a pretty fair, if they somehow get AI to start working for Adobe better and they advance their products, I think they still could increase that profit margin back up to that area with the bull case. So now taking a look at the P ratio and the shares of the company right here, I'm going to take a look at the P ratio to give us an idea of the valuation of the company. We can see the P ratio continues to decrease over time while the earnings per share continues to increase. So that's actually a good thing for this company. And right now their P ratio is at about 22, so it's actually pretty low. And the average is actually at 40. So it's trading at a very low valuation, and I think think it's the lowest it's ever traded at. So this is pretty interesting time to potentially buy. And also looking at the shares outstanding, they've really started buying back in the past few quarters as a result of the stock going down, and they bought back almost 5%. They literally bought back 5% just this last quarter, so they're really starting to buy back shares year over year, so this is good for the company. So going over to my intrinsic value calculator, with a future P ratio for the bear case, I think for Adobe, say they grow at 6%, I think a fair bear case is 18 PE ratio, and then for a base case, I think a 22, and then a bull case, a 26 PE ratio for Adobe, because the market trades at about a 25 to 30 PE ratio, and the big tech cap stocks are growing at about 10 to 12% revenue growth rate or even higher. So that's why for the bull case, I'm putting a 26 PE ratio. Now for the shares outstanding, like I said, they're really buying back, but do I think they're going to continue to buy back that fast? Probably not. But their average over the past 5 years is at about 3%. So with the bear case, I think they're going to buy back at 2%. The base case, let's say they buy back at 3%, and then the bull case, they buy back at a whopping 4% each year, because just last quarter, the last few quarters, they've been buying back at 4 to 5%. So that being said, taking a look at the annualized return I think you can make on the bear case, I think you can make almost 1% each year. But on the base case, I think you can make upwards of 11%. And for the bull case, I think you can make 22+% on your return. So if you believe the base and bull cases, I think this is a very good time to buy this company. Me personally, I think a good target price could be about $300 to buy this company. I am slightly worried about the future with this company because of AI and the competition and diminishing pricing power, but honestly, I think if this company gets to a decent valuation and waiting for their next earnings to see what they have to say, this could be an actual good undervalued company that people are writing off. So with that being said, please subscribe, hit the like button, comment down below what stocks you want me to analyze next, and give me some feedback on this video and what you think about Adobe stock. Thank you guys for watching. See ya.